Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-hosts, Mark Honf and Nam Phan of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is general trivia. Nam, what do you have for us? You want to start us off?
Yeah, start us off again with mortgage rates. So this article, I think, came out this morning. 30-year mortgage rate hits yet another record low. So, gosh, it seems like we've been hearing these headlines almost weekly or monthly
Well, we have
several years.
So 12 consecutive weeks, mortgage rates have been below 3%, and it's the 10th broken record this year for a new low. Now, I think 2.81 is only like 1 basis point below the previous record of 2.82. So it's not like it's it's still, it's funny, they celebrate every basis point savings in mortgage rates. But I guess the thing is that I remember we did a show earlier this year where we said that mortgage rates weren't likely to even go below 3 because there's a certain amount of fixed costs that you can't eliminate.
Yeah.
But that notwithstanding, they're eliminating some of that.
Yeah. I mean, in the 15-year rate, it remained unchanged from the prior week at 2.59%. But, this is on top of already low rates. The article goes on to say, despite waning demand, applications are still far ahead of last year's levels in both the refinance and new purchase sector. The refinance index was up 44% year over year, while the unadjusted purchase index was up 24% year over year, according to the Mortgage Bankers Association. So, I mean, this is going straight into the Q4. Well, we're in Q4 now, but it'll be interesting to see how this impacts the rest of the quarter. December is typically a really busy month for us just because people try and wrap up transactions before the end of the year. On our side, demand is still really strong. I think this time last year, we saw a little bit of a dip going into October, and then it carried over to like early November, and then picks up again. But we're not seeing any dip so far.
Let me ask
it's a really interesting year. Go ahead, Edward.
With the election happening next month, have there been, you think some people would just sit on the sidelines kind of wondering, what's going to happen, whoever's going to get in office?
Well, and again, just to kind of, lay the foundation for the audience, for any new listeners, on the Best of Investing, we typically start out by talking about what's new in real estate and mortgages, and primarily residential real estate, because that's the most exciting sector right now, and the only sector that's really thriving in the real estate marketplace. And on mortgages, and again, it's residential mortgages that are benefiting from these low rates. And at Pacific Private Money, who sponsors this show and who Nam and I run that company and have since 2008, we make mortgages, primarily alternative mortgages, also called private money or hard money loans, fast funding, short-term loans where people need to rent money that they can get quickly and easily to execute a real estate transaction. We fund all those loans with private capital, and so we discuss, and most of those loans are residential real estate. So on the Best of Investing, we're oftentimes discussing what's happening in money, what's happening in real estate, because we make real estate loans with our investor capital, and we invite investors to increase their capital positions with us. And we're always looking for more investors to join in with the family of investment strategies that we employ at Pacific Private Money. Since we lend mostly on residential real estate, we're very, very excited that this year has not been the real estate pandemic that many were predicting. And one of the articles I have here that I really enjoyed reading, and I just took a few excerpts from it, is that a gentleman wrote an article and he titled it, "The Forbearance Crash Bros Spoke Too Soon." So we coined the term forbearance crash bros. And what he's talking about is that there's a segment of the real estate investment community that has been very bearish. It's kind of akin to those bears that kept calling for the real estate, for the stock market to crash for the last 5 years,
Oh, yeah.
or those Tesla short sellers that were wondering when they were going to, when Tesla stock was going to crash. So you have these forbearance crash bros that continually are hyping real estate price crash. And so I don't quite have enough time, I don't think, in this first segment to go deep into that. I'll talk about it a little bit later.
Sure.
And we also have some updates on what segments of the residential market are doing better than others. It might surprise you. And also what areas of the real estate market are actually, not doing well, depending on what side of the fence you're on. Better for consumers, not so good for landlords.
All right, guys, going to cut to our first commercial trivia break question here. In what decade did the Dust Bowl devastate U.S. Midwest farmers? What decade? All right, call 888-912-1190. First caller with the correct answer is going to win that 5-pack tanning certificate. And want to make a mention here for the Elk Cove Inn. So discover one of the most romantic and COVID-safe certified boutique inn or bed and breakfast on the Northern California coast. The Elk Cove Inn is one-of-a-kind ocean view, Mendocino Coast bed and breakfast, luxurious accommodations. When you visit Elk Cove Inn, you're greeted with a gift basket full of cookies and wine. You guys know I love that. And of course, champagne and delicious complimentary breakfasts are included. Give them a call at 800-275-2967 or go to elkcoveinn.com. Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hanf and Nam Phan of Pacific Private Money. First trivia question, excuse me. In what decade did the Dust Bowl devastate U.S. Midwest farmers? What decade was it?
I don't know. I didn't do good in history.
20s?
No, it was the 1930s.
Yeah.
So right after, during the...
Right alongside the Great Depression.
Right alongside, yeah.
Those poor folks.
Like a double whammy there. Mark, go ahead and continue on. You were talking about the different segments of residential real estate.
Yeah, so I want to just share with you this article I thought was kind of funny, titled "The Forbearance Crash Bros Spoke Too Soon." So the health and economic crisis, of course, has made 2020 a horrific year for many Americans. Added to all that misery, we had terrible fires in the West and hurricanes in the East. From this author's perspective, the ball in Times Square can't drop fast enough, hailing an end to 2020. One might think with all that bad juju circulating on the planet, people would be extra careful not to bring more misery upon themselves. But then we have our band of housing bubble boys who shamelessly never miss a chance to call it wrong in epic fashion. Some of their biggest hits, or should you say misses, in the last 8 years have been the never realized silver tsunami crash, the ever popular investor supply crash, the Airbnb supply crash. And this year, the COVID-19 was for sure going to send prices crashing 30 to 50%. Despite what they promised, we sit here today with the United States housing market outperforming all other economic sectors in the world during this pandemic. But hey, at least they are consistent in their catastrophic failure to predict what will actually happen. Also in predictable fashion, after time proves one of their crash predictions wrong, our band of bubble boys, bubble boys reminds me of the Seinfeld episode.
Seinfeld, yeah.
Our band of bubble boys have a proclivity for moving the goalpost. The COVID housing crash of 2020 that they promised has now been repurposed as the forbearance crash of 2021. According to this new and improved crash thesis, when the forbearance plans time out in 2021, home prices will crash 30%, 40%, maybe even 50%. Real estate's going on sale, guys.
Wow.
This will make their daily trolling of America for the last 8 years worth it.
Can you go into a little more depth on that? Why, with regard to the forbearance issue, what play this out for us?
Well, I'll answer that by saying that this year they were calling it a COVID-19 crash because of the unemployment. And historically, real estate prices have been tied to real estate. Where you would want to invest in real estate in the country, you would usually tie that to looking at things like job growth, right? A strong job market, historically has equated to strong real estate market, strong underlying principles. But that didn't happen. So the 30 to 50% crash didn't happen. In fact, real estate across the country is up anywhere from 5 to 15% prices. I mean, it's unbelievable, and no one could have predicted that.
Yeah.
Now, the forbearance crash they're now calling for, and I've seen a lot of articles about this too, and I don't believe it. I think it's nonsense. But what they're hoping for is that when the forbearance agreements that banks have given to homeowners so that they don't have to make 3 to 6 months worth of payments, when time runs out on those, and they're saying that they're starting to run out now, and presumably some banks have extended that forbearance
That's what I'm expecting.
to some borrowers, to some homeowners. They're predicting that there's going to be an increase in foreclosures, et cetera. But here's the thing. Congress is not going to let that happen. They've already passed a slew of laws. They're going to pass a slew of more laws. There's not going to be any foreclosure wave coming. People are not going to be booted out of their homes. It's not going to be good news for banks. It's not going to be good news for lenders that have a portfolio of non-performing, non-paying loans. But it's not going to result in a real estate market crash. It's just not. The metrics don't support it. And really, those people predicting a real estate market crash are really trying to sell something at the end of the day. They're trying to sell their get-rich-quick in real estate programs, coaching, books and tapes, as they used to call it, the videos. There's always going to be people like that. I mean, just like the guys that still fill my Facebook feed with, 9/11 was an inside job. There's always going to be those crackpots out there predicting, a way for you to get rich on the coming, the coming chaos.
I mean, it's
But,
pretty simple.
really not going to happen.
Supply and demand.
Yeah. So let's pivot on to the real estate market. What sectors are doing good? Here's the surprise, and I wouldn't have guessed this. Luxury home sales have surged 40% in the third quarter.
Wow.
As sales of affordable homes, lower priced homes, falter, highlighting the pandemic's uneven impact on Americans with less wealth. So interesting. That's what they're called, the so-called K recovery, where the rich get richer and the poor get poorer. This lends a little bit of support to that. So luxury home sales increased 40% year over year in Q3. However, sales of median-priced homes climbed just 3%, and sales of what they call affordable homes, lower-priced homes, declined 4%. So there's really very interesting. The luxury housing market normally takes a hit during recessions, as we all know. That's usually the first market, and I would have guessed that would have happened this year, but it didn't. It's exactly the opposite.
Also, the houses then in the lower end market, is that across the board, or you have to go still in sub-markets?
I don't know. They're not clear on the data on this. It was a fairly long article, so I picked some of the highlight paragraphs out of this. I didn't want to go too deep into I didn't have time before the show to go too deep into the graphs, but so I don't know where they picked this up. This would be interesting. I think I'll bring this back next week. But it does say that remote work, record low mortgage rates, and strong stock prices during the pandemic are allowing America's wealthy families to gobble up expensive homes with home offices and big backyards in the suburbs. Meanwhile, scores of lower and middle class Americans have lost their jobs or are still renting in the city because they're essential workers and have to commute to work, so they're unable to reap the benefits of home ownership. So, interestingly enough,
the rental market in San Francisco's dropped though quite a bit, hasn't it?
Well, that's another. We'll go into that in a little bit. Handful of West Coast metro areas have fueled the surge in luxury home sales, including Sacramento. Luxury sales soared 86% year over year. Really, what's happening is a lot of people are moving to Sacramento from the more expensive Bay Area. There's an exodus, of course, from San Francisco into the suburbs, and Sacramento's picking up a lion's share of those moving out of the cities.
I thought it was just the politicians getting richer and getting into their bigger mansions, their mansions,
Yeah, the Sacramento Metro was the most popular destination for home buyers looking to relocate in July and August, according to Redfin. San Francisco was the top origin of out-of-area buyers looking into the Sacramento area. So exodus from San Francisco to Sacramento, very interesting.
Wow.
All right, guys, getting to our second trivia question, commercial break. What color are cranberries before they turn red? Call 888-912-1190. First caller with the correct answer is going to win a tanning certificate. And don't touch that dial. The Best of Investing. I'll be right back. Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with Mark Hahn, excuse me, and Nam Phan of Pacific Private Money. Second trivia question, what color are cranberries before they turn red?
Green?
That's
Green.
what I would have thought.
Yellow.
No. White.
What?
They're white color. Yeah, isn't that weird?
I'm gonna go Google that after this.
I don't know.
You want to continue on with the luxury market?
Yeah, Mark was mentioning in the last segment how the luxury market has been really strong since over the last several months. And last week on the show, Patty was talking about that in Marin, how so many of the high-end properties or high-end markets were just seeing a ton of offers. And I just did a quick analysis of the last 22 loans that we did that closed, and 6 of them were over $1.5 million. So that's, and our average loan during that time was $1.1 million. Our highest one was the $3 million loan, and a number of or 8 of them, I should say, were bridge loans. So we had a significant bump in the average loans that we've done over the last 90 days than the previous 90 days. So Q3 for us, our average loan size went up a lot, and that kind of tells a story of where these bars were coming from.
Yeah.
A lot of them were in these high-end markets.
Okay.
Yeah, absolutely. It's just been one of those unpredictable years in so many different ways, the way it's played out. But one of the bright spots for listeners, for those of you with money to invest, whether you are selling real estate or maybe taking some of your profits out of the stock market, which continues to go up in defiance of almost all predictions. We didn't have that annual October massive adjustment, or at least not yet. Yeah, we'll see what happens during the election. It could.
Well, let's get into the
yield some surprising results.
Let's get into the investment side of things. We got an email here from a listener. It says, "How can your Freedom Fund provide such ease of liquidity?" So this person obviously has been listening. Why don't you kind of backtrack and fill in the gaps on this one?
So we offer multiple ways for accredited investors to earn above market yields on their savings secured by real estate. And I said accredited because 4 of the 5 ways you can invest with Pacific Private Money are through mortgage funds, mortgage-backed funds where the assets of that mortgage pool are real estate secured loans. The 5th way is we still do individual trustee investing, and we have a number of clients that prefer to invest in individual notes. They'd rather not be in a fund. These are your more sophisticated, people who've been doing this for 10, 15, 20 years, oftentimes like to manage their own portfolio of notes, although those are getting harder and harder to find these days because so many institutional buyers are buying product from us. And so our funds have become more popular as a method for earning anywhere from 7 to 12% on your money secured by real estate. So the Freedom Fund is our most flexible fund, albeit we do have the highest initial deposit requirement for that fund. It's $250,000. The Freedom Fund is a fund where we use the money in that fund to fund and close loans, real estate loans, that we're going to sell to a third party within 30 days. So the Freedom Fund for our company acts like a warehouse credit line. And if you're familiar with how mortgages work, warehouse credit lines are used by lenders to provide additional capital to close a loan, but they have to clear those lines usually once every 30 days, meaning they've got a buyer for them. It could be anywhere from 1 week to 3 weeks to turn around and sell that loan. The reason that we have to close loans in advance is that most loan buyers, they want to buy an existing loan. So it's incumbent upon originators like Pacific Private Money to actually locate the loan, underwrite it, document it, fund it, close it, and then once it's closed, we have an existing security that we can sell. So the Freedom Fund is used, it's not a portfolio lender. In other words, we have other funds in our mix that are longer term investments. They pay a higher rate of return, but your funds are locked up for a minimum of 12 months. And you know, we fund loans and we keep them in the fund. So for example, our Pacific Private Money Fund has $62 million worth of loans currently as of this past month, and that's paying about 7.5% right now year to date to investors. Freedom Fund is designed for those who have capital that they would really like to make money with, earn more than 0.5% interest from their bank, but they want to keep it relatively liquid. So we do not enforce a lockup period in that fund. So if you invest $250,000, $500,000, $1 million, we have several $1 million investors in that fund already. You can take that, you can request that money back. We ask for 30 days advance notice, but oftentimes because we're liquid twice a month in that fund, we can reliably pay your redeem your capital within 2 weeks. So again, it's just a tool that we use to be able to close loans that we know we're going to sell. Therefore, it's designed to be a highly liquid fund, and as far as I know, it's unique. There isn't any other fund like this paying 7%. There are similar funds paying 4% and 5%, but we decided to be a little bit more aggressive, knowing that a lot of our clients, it seemed that 7% was a sweet spot that we could pay, that we could still make money with that money, and they would feel like, gosh, 7% and with no lockup and liquidity, so I can
exactly
keep it at bay if I wanted to buy stocks or buy a fancy car or buy a house.
Yeah.
Can I tell you a quick story? I had a call with an investor today, and he said, hey, listen, I have $101,000 that I want to wire as soon as I can into my Pacific Private Money Fund account. And he said, how fast can I get it in? I said, I'll send you the paperwork. He said, I invested this money, $100,000 3 years ago, and I checked my balance today because I'm so busy I forget. And after 3 years, I've earned $1,000. And he said, how much would I have made had I invested that in the Pacific Private Money Fund over the last 3 years?
21,000 or more.
Essentially 24,000.
Yeah. With compounding, yeah.
Yeah, he's reinvests his earnings. So he said, I need to get it over as quickly as possible. I'm so angry.
Yeah. How do people get a hold of you, Mark, if they're interested in this fund?
Well, our website has a lot of information on our funding opportunities. Go to pacificprivatemoney.com, click on the invest page. That's pacificprivatemoney.com. Click on the invest page. We're just adding a fourth fund, our newest fund, the Pacific Southwest Note Fund, is being added to that page in the next couple of weeks. But the Freedom Fund is on there, as is the Pacific Private Money Fund and our third fund, the North Star Capital Fund. So for more information, check us out.
All right. Third trivia question. What element has the chemical symbol K? Stay with us. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hanf and Nam Phan of Pacific Private Money. Third trivia question was, what element has the chemical symbol K?
Potassium?
Potassium. There you go. Very good.
Oh, look at that.
Hey, you're just such a chemist. What can I say?
Studying chemistry.
Okay, so let's get into a deal of the week. So I have just a quick little story one where this guy, he's got great credit. He's got almost an 800 FICO score, makes good income. I mean, he's your perfect borrower. The problem was that somehow he heard about these forbearances and decided, well, if the bank's not going to make me pay my mortgage payment, and just add it on to the end, or something along those lines, where I just basically,
if it's free.
If it's free, yeah. I mean, eventually he was going to have to pay it back, but he just, why should I pay it if I don't have to, right?
Why would I not take advantage of that?
Exactly. Well, he did it for 2 or 3 months, and unfortunately, somehow now he's wanting to refinance, and sure enough, he can't get a loan from a conventional bank. Why is that?
Oi.
Because credit reports, while it doesn't lower your score to participate in your bank's offer to allow you to forbear your payments for a short period, it does show up as a memo item in your credit report. So your score stays the same, so it's abiding by, the credit companies are abiding by the regulations, but it still becomes a scarlet letter for the borrower because credit reports do indicate whether or not you've requested and or received or participated in a forbearance program with your bank. And when another bank sees that, they decline your loan application.
And it kind of makes sense because if I'm the new bank lender, I'm going to say, well, if you didn't pay your last bank, how do I know you're not going to pay me either? So
Right.
I get it.
Well, you've seen articles, so a number of banks have been accused of putting in place forbearance programs when the borrower actually didn't ask for it.
Oh.
And it actually, anecdotally, I don't want to say actually but according to the papers I've seen in some of the press, there were real people who complained that they could not move and or refinance their mortgage because lo and behold, there was a forbearance memo item in their credit report that was not accurate nor requested, and they were damaged as a result.
Yeah,
and
that,
so anyway,
to me,
it's really
if
a
I'm
big
an
deal.
attorney, that's a pretty big lawsuit against the bank.
Well, yeah, absolutely. But still, just like when the IRS makes a mistake, it's like oopers, it doesn't help your credit report, which is why companies like Pacific Private Money exist.
Okay, very good. Nam, you have a deal of the week for us?
Actually, I have kind of a deal summaries of the last, again, 22 loans that we did.
Talk about that big one we just closed in 3 days.
3 days, yeah. So this, I think we chatted about it a little bit last week, but we actually closed a deal last week that came to us on essentially a Sunday and closed on a Wednesday. And not only was it a record for us, I think, but the size of the loan, it was $3 million.
Yeah, so not a small loan. So, and again, luxury market, we're seeing a lot of luxury market bridge loan requests. And this was somebody who had an opportunity to buy real estate. And was this one where they had financing lined up and it glitched?
Yep, financing lined up, it glitched. And so we came to the rescue and closed this deal. We got it, we worked on it first thing Monday morning, funded it on Tuesday, and it closed on a Wednesday.
So if you're a real estate professional listening, if you're a realtor or mortgage broker, and you don't know that this tool exists to help your client in a pinch, you're missing out on opportunities to close more deals because it's such an amazing tool. And it's not hard money like you remember it. I mean, we price our loans, as low as 8%, which again, if you keep in mind that these loans oftentimes there's no prepayment penalty. So you're renting the money on an 8% annualized rate, but you only pay for it as long as you use it. So if you hold the loan for 60 or 90 or 120 days, you're not paying 8% for that money. It's
And to continue on with that, I'm actually going to be doing a webinar. I'm invited by a mortgage broker to talk about the transitional bridge loans on October 23rd, 10:45 a.m. And it'll be an Eventbrite. And people should email Edward at pacificprivatemoney.com. I have my own special email with pacificprivatemoney.com if they want to get the Eventbrite and participate in the webinar. I'd be glad to share that with them. And we'll talk all about how the transitional bridge loans work. And
yeah,
also,
if I can add on to what Mark was saying, if you're a realtor or mortgage broker, again, going back to these last 20 some odd loans that we closed, the average time to close was 16 and a half days. So we're getting these loans and we're able to process them very quickly. The shortest being 4 days and the longest being 36. I mean, we like as much time as possible, but we also know people are coming to us at the 11th hour. So we're closing these in a little over 2 weeks. If you're an investor, it's good to know, on the investment side, what's the quality of the borrowers that are coming in?
Oh, yeah.
And of all of these loans, only 2 out of the 22 loans that I looked at, the last 22, had a FICO score below 650. So the average was somewhere in the like 720, 725 range. So
And 800 credit scores are not unusual.
not unusual. Yeah, actually about 6 or 7 of them had 800 or higher FICO score.
And
And we still get questions from people, why would someone with an 800 FICO need to use you? Why can't they go to the bank? Because the banks don't make loans that fast.
No.
They can't. They can't do 21-day. Well, sometimes there's some sources of financing that can do 21-day closes, but people generally come to us for several reasons. One, they're literally out of time because their bank financing glitched and they're going to lose their deposit, or the seller is going to sell them backup offer, which there usually is in this market. Or number two, they want to make an offer that looks like a cash offer. They want to make a non-contingent, fast closing, or low contingent offer, and they want it to look like cash. They don't want to have a financing contingency. So that's another way you can use our loan product, because we pretty much give you we can give you a funding commitment that you can go to the bank on, so to speak. So, so there's a lot of ways that, a lot of reasons why realtors and mortgage brokers call us to inquire about that option with their client, and we do things banks simply cannot do. And then the third reason people come to us is we can provide 100% financing to buy the property you're looking to buy now, and not require you to move first or sell your house first to free up the equity. So this is something that banks won't do, but we can do a loan crossed by 2 properties. So we can cross your target property and as well as your existing property, and lend on your equity in your existing home, so you don't have to sell first. You can buy the house first. So it's a very, very creative tool, a lot of different uses, and banks just simply don't have that product or capability for speed.
And before we cut to break, Nam, Pacific Private Money's going to be doing a webinar.
Yeah, so our next webinar is November 18th at 6 p.m. I believe that's a Wednesday. And so you can learn more about not only the Pacific Private Money Fund, but all of the funds that we offer. We had a great turnout on the last one. We are in capital raising mode. We've got so much loan demand that we just need the additional capital. So if you want to learn more, you can give us a call, 415-883-2150, or go to our website. We'll have it on the events page shortly.
All right, stay with us. The Best of Investing will be right back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Nam Phan and Mark Hanf of Pacific Private Money. No trivia question, but Nam, you wanted to continue on with the event.
Just on the last segment, we were talking about when the next fund event is, and again, it's November 18th, which is a Wednesday. It'll be a couple weeks after the election, so hopefully there won't be so much hysteria and chaos in the streets. But it'll be at 6 p.m. And one of the things I want to mention is, we offer 4 new funds, or we offer 4 funds, and Mark mentioned that you do have to be an accredited investor, but the nice thing is you only have to get accredited with us once. And that accreditation allows you to invest across all of our funds or any future funds that we may offer. And so, it's a very convenient way to get certified and look at diversifying your portfolio. We've had a number of investors who have invested across 2 to 3 of our funds now. And for our Freedom Fund, we're going to be launching an online portal so investors can track their investment there next month. So we're doing a lot in terms of providing the transparency for our investors, giving them more options to invest. But really, now's the time, because we've got, as I mentioned in earlier segments, Q3 was a record quarter for us. Q4 will probably be a record Q4 for us, I imagine, just with the pace that we're on. So, if you're concerned about uncertainty with the stock market or whatever, we've been emphasizing how real estate has withstood so much this year, it's continuing to be strong for us, and we follow economists, and they're saying it's going to be strong going into 2021 and beyond the next 3 years. So for more information, give us a call at 415-883-2150.
Yeah, because you guys have been paying between 7.5% to 8% on the main fund for the last 7 years, right?
Yeah, since 2013. So we've been using mortgage debt as a strategy for generating yields for investors since 2008, And even if you're a believer that real estate prices are going to decline in California next year, and again, I say California because virtually all of our loans are made here in California, a small percentage outside, but 90% here in California. If you believe that we're due for a 5 or 10 or 15% correction, don't forget that we don't lend like the banks at 80 or 90% loan to purchase price or loan to value. We solve for a 70% loan to value or less. So we bake in the protective equity in the event of a market decline. And even and 70% is usually on a purchase money transaction where we really feel comfortable with the value of the property. If it's a refinance, like cash out, someone pulling cash out on real estate they own, we typically go no higher than 60 to 65%. Again, trying to be conservative. We don't want to end up having to foreclose on a borrower if they're borrowing money for to risk in some business initiative that may not turn out. We have a lot of deal flow, so we're very choosy in the types of loans we make, and we've never lost $1 of investor principal ever since 2008. And there's been a lot of real estate activity since 2008. Some of it going downward in those years. So again, for more information, check us out at pacificprivatemoney.com. We do these events, these webinars, to kind of introduce you to more deeply to our company and to share with you the ways you can invest in mortgage debt for a higher yield on your savings. And again, always go to our website because we're always adding more information, pacificprivatemoney.com.
All right, guys, we're going to cut out. Here's our thoughts for the day. Research has shown that laughing for 2 minutes is just as healthy as a 20-minute jog. So now I'm sitting in the park laughing at all those joggers. It's like Mark was saying about how sore he was working out, right? And
That's right.
And I like this one. Make today so awesome that yesterday gets jealous. I like that. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.